Have you ever wondered why the rich keep getting richer and they literally pay no money in taxes? In this video, I'm going to be breaking down the exact tips that you need to know in order to be able to live tax-free and be able to build generational wealth. All right, so let's go ahead and start off with the first thing. What is a tax write-off? What is a tax deduction? What are these concepts, okay? So basically, a tax write-off is what is called a tax deduction, okay? So a tax deduction is going to be a reduction in your taxable income. So as it relates to taxes, let's say you go ahead and make $1,000 in income, okay? $1,000 is going to be taxed at your tax rate. So depending on where you fall into that tax rate, you're going to have to pay taxes on that money, okay? It is a taxable event. Now you have to pay taxes on it. So in the United States, the tax system is actually what is called progressive. So there's different levels of different rates that you have to pay. So depending on each dollar that you make up to a certain amount, it goes higher and higher and higher, right? Progressively gets higher. So it could be 10%, then it could be 12%, then 24%, then 37%. Like it just continues to increase depending on how much money you're making, but then also depending on the year. The government is constantly changing that. So you just want to make sure you're aware of that. But so going back to this concept of a tax write-off and a tax deduction, if you have this $1,000, you now have to pay taxes on that depending on your tax rate. So what a tax write-off allows you to do is it allows you to be able to reduce your taxable income. So let's say, for instance, you make $1,000, you had no deductions. Let's say your tax rate is 30%. Now you're paying $300 in taxes, okay? That's too much tax. So what you want to make sure that you're doing is that you go ahead and take advantage of what's called a tax deduction, and it's going to allow you to be able to reduce that. So now let's say you actually make $1,000 in your business, and now you have a tax write-off of $200. Okay, so let's say you have a tax write-off of $200. Now your taxable income is $800, which is less than the $1,000. Let's say that tax rate is still at 30%. Okay, now you're only paying $240 in taxes. So the difference there is $60. Okay, $60 in tax savings. Now let's say you make $10,000. Let's say you make $100,000. Okay, that can significantly increase and really make a big difference as it relates to your taxes. Okay, and why is this so important for you? So one of the things that you need to understand is this: the IRS tax code that actually favors business owners and entrepreneurs. Why do they favor business owners and entrepreneurs? They understand this, okay, that as a business owner, you are employing people. That is one less person that the IRS has to go ahead and give money to. Now you are also creating products and services. That is less of money that the IRS has to go ahead and do to create products and services for the country. Also, if you are an investor, okay, you're investing into companies, that's one less dollar that the government has to go ahead and invest into companies. If you're investing in real estate, that's one less person that the government has to put in public housing. So you're helping the government out. And because of the tax system, they understand this. Based on history, they understand that depending on how things are taxed, it's going to impact behavior. And one of the behaviors that they want people to have is they want people to be able to make more money, but then also do the things that the government wants them to do. So with the tax write-off, it's going to be a tax deduction, it's going to be a tax break, it's going to be a tax incentive for you to do the things that the government wants you to do. So again, if you are a business owner and investor, the government wants you to do that because now you're going to be able to provide them with different benefits. And as a business owner, you are open up to significantly more tax write-offs and tax deductions versus just a W-2 employee. As a W-2 employee, you're basically limited to what is called the standard deduction or itemized deduction, okay? And these are the two deductions that you're able to take if you are just working a 9 to 5. So the standard deduction is the automatic deduction amount that the IRS gives you each and every single year depending on your filing status, okay? So if, let's say you're a single filer, let's say hypothetically speaking the year is 2024, you're able to now to have a standard deduction of $14,600, okay? And if you're married, that number typically doubles. If you're married filing separately, if you're head of household, depending on your filing status, that is going to change. Now you also have itemized deductions. Itemized deductions are going to be an opportunity for you to take even bigger deduction if it goes over and beyond whatever that standard deduction amount is. And there's actually a couple of requirements and a couple of things that the IRS is looking at in order for you to be able to itemize your deductions, okay? And the acronym that I want you to write down is MITCH, okay? MITCH. It just coincidentally happens to go on my name. It's going to be a really great opportunity for you to remember exactly how to be able to save money on taxes. So the first part of that is medical expenses. So if you have medical expenses during the year, that is going to be an opportunity for you to be able to deduct that for taxes. If you have interest paid during the year, like interest paid like mortgage interest, one of the things the government also wants you to do is to be a homeowner. So they want people to get homes, so they give you a tax break by owning a home. One of the tax breaks is going to be that mortgage interest. You're able to go ahead and deduct that for taxes. T is going to be taxes, so taxes paid, the property taxes on that home that you purchased, that's going to be deductible for you. C is charitable contributions. If you're donating to a 501c3, that is one less organization that the government has to go ahead and serve. So now you're able to go ahead and get a tax break for that. And last but not least, H is help. So if you have casualty losses or something significant happen in your life, the IRS also allows you to be able to deduct for that, right? And there's different rules and limitations on each of those, but I just want to give you a high level of how those work, okay? So you have the standard deduction and itemized deduction. And if your itemized deduction, if it's bigger than the standard deduction, then you're able to have a bigger tax write-off, okay? So you want to make sure that you're recording all these expenses. You want to make sure you're tracking it during the year, and then you go ahead and give it to whoever is doing your taxes, your tax strategist, your tax professional, go ahead and do that for you. So now moving on to business owners, okay? So business owners have a lot more tax deductions that they could take, right? The W-2 person had the standard deduction, itemized deduction. They also have retirement contributions they can make. They have other things that they could do, but really the vast majority of the tax benefits are going to be for the business owners and investors, okay? So as it relates to being able to deduct things for taxes, as a business owner, you want to make sure that you write down this acronym. It's another acronym I want you to remember, and it's called tax-free, okay? F-R-E-E, okay? Free is the acronym that I want you to remember, and there's 4 requirements in order for you to be able to deduct things for your business. The first part of tax-free is going to be F. F stands for, it needs to be for your trade, business, or profession. So if you are a business owner, again, which I recommend because you get tax breaks, but then you're also able to increase your wealth and earning potential, then you're able to go ahead and be able to deduct for different expenses. The next thing is going to be R. R is going to be regular. The IRS wants you to be able to spend money on things that's ordinary for your type of business. So you want to just look at your business and what is going to be ordinary for that type of business to be able to operate. As a CPA, what's ordinary for my CPA firm is going to be computers, laptops, software, notebooks, calculators, office equipment, rent. All these things are considered ordinary for my business. On the other side of things, let's say you own an ice cream shop. One of my friends owns an ice cream shop. She's able to write off the freezer, napkins, spoons, ice cream, okay? Like I cannot write that off on my business because that's not really ordinary for a CPA firm. So that is going to be the R. The next is going to be E, essential. What is going to be essential in order for you to operate your business? The IRS calls that necessary. So what's necessary for your business is rent, utilities, employees, hiring professionals. That's going to be necessary in order for you to operate your business and make sure that your business is successful. So the last E is going to be economical, and the IRS calls that not lavish or extravagant under the circumstances. So what does that mean? So basically, the IRS kind of leaves some gray area and allows you to be able to make your own decisions, okay? So they're not really trying to restrict you as far as what you're able to deduct. The IRS wants you as a business owner, as a taxpayer, for you to go ahead and use your judgment to identify what is going to be reasonable for how much money you're making in your business, okay? And believe it or not, right, as it relates to the tax code, by the way, this is just a side note, as it relates to the tax code, there's over 75,000 pages in a tax code, and believe it or not, literally over 90% of it actually tells you how to be able to save money on taxes, okay? And again, that 90% is going to be related to the business owner and the investor. But going back into this not lavish or extravagant. So let's say, for instance, one of the things that you're able to deduct for your business is being able to write off jets, being able to write off vehicles, being able to write off being able to write off yachts, depending on your business. Well, depending on how much money your business is making, you may not necessarily be able to do that. If your business is just starting off, you're only making $10,000, you trying to go ahead and try to buy a vehicle or a yacht, or going ahead and spending like thousands of dollars on business meals, that might be seen as lavish or extravagant. But if you're a multimillionaire, if your business is making a lot of money, if you have a luxurious brand, then those things may not necessarily be considered lavish or extravagant. Again, so you have your judgment, but you want to make sure that you are following these rules so you're able to not necessarily trigger what's called an audit, okay? And an audit is when the IRS comes back and says, hey, we don't necessarily agree with what's on here. Can you go ahead and explain? Can you go ahead and justify it? But understand this, when it comes to taxes, you do not have to be afraid of an audit. Just understand that the tax law is what I just mentioned. It's a law. And when it comes to any type of law, as long as it's supported by facts, you're able to change your situation. So the key thing I want you to understand is, in order to change your tax, you must change the facts. You must change the facts of your situation, and that's what's going to allow you to be able to do that. And if you're going ahead and making sure that you're checking all those 4 requirements that I mentioned, right? It needs to be for your business. If it's regular for your business, if it's essential, if it's economical for your business, that's going to be the opportunity for you to be able to increase your ability to be able to defend yourself in the event that you get audited. All right. So that is the tax-free acronym. Okay. And that is what the rich use, and that's what the wealthy use, and that's what business owners and investors use to be able to save money on taxes. So why is this so important for you? Okay. As it relates to being able to write off things for your business. And just to clarify, the difference between a tax write-off and a tax deduction is basically the same thing. Tax write-off is just a more informal way to say it, but on your tax return, it's going to say a deduction. Okay. So just be aware of that. But the deduction is going to be something that you're able to now deduct in your business to reduce your taxable income. So what are some common tax deductions for you as a business owner? So meeting those 4 requirements, that means that if you're driving for business purposes, that could be a tax deduction for you. If you're traveling for business purposes, that could be a tax deduction for you. If you are eating and you're discussing business, that could be a tax deduction for you. If you have a home and you have a space within your home that you're using for business purposes, that could be a tax deduction for you. If you're using a camera, a microphone, a computer for your business, that is now a tax deduction. Your drone, yes, can be a tax deduction for you if you are using it for business purposes. So again, that is one of the beautiful things. That's what the rich and wealthy know. They're able to take what's called a personal expense, which is typically not tax deductible, and now turn that into a tax deductible expense by changing the facts of their situation to making it relate to their business, y'all. It is a game changer. Once you understand this, like when you really understand this, you are literally, you just hit the matrix. Like you almost, you kind of put your little pinky toe into the Illuminati a little bit, okay? But like now you're able to understand and really be able to move differently. So you want to be thinking like in your life, like what can I do, or how can I go ahead and change my situation in order to be able to take a tax write-off? So instead of asking yourself, okay, can I write this off? Is this a tax write-off? You want to be thinking about like, how can I write this off? Like, how can I be thinking about this to where it could be related to my business? Paying your kids, okay? Another great tax deduction, tax write-off for you is being able to pay your kids through the business. Why? Because now they're employees, and one of the extra benefits of being able to pay your kids through the business is because they're your children, they're your dependents. You're not having to pay that payroll tax on being able to have them as your employees. So that's a really amazing benefit as well. And because they have earned income, you go ahead and put that money into a retirement account. They can have a whole bunch of money there for retirement. And by the time they turn 18, they can literally have over 6 figures in their account, y'all. This is like, I get so excited about this stuff, okay? So ultimately, when it comes to all of this, documentation is going to be key. Like I said, it is a factual type of thing. So you want to make sure that you are able to be protected and you're able to justify what you've been doing. So having some types of documentation is going to be key. So making sure that you're keeping good records. So making sure that you're using a software such as QuickBooks. QuickBooks is a really good tool. It's probably one of the best known and most used accounting software out there. You can go ahead and use QuickBooks. You can even use a spreadsheet as well. So you don't necessarily have to make this overcomplicated, but as long as you're documenting your income, your expenses, that's going to be great for you. Also, you want to make sure you're keeping your receipts as well. The IRS has a minimum, so they say if it's under $75, you don't necessarily need to keep a receipt, but I still recommend keeping a receipt. At least just take a picture with it on your phone, save it to yourself. You can actually go ahead and just send your email. A really quick hack that you can go ahead and utilize is you can actually create an email account that says receipts, so receipts at your company name, and now you know anytime you go ahead and take a picture, you can go ahead and send that and you have it all organized for yourself. Like I said, you don't necessarily need it to get your taxes done, but you do need it in the event that you get audited. You can document and show how each of these are legitimate business expenses for yourself and your business. A pro tip for you to keep in mind is that you should be working with a tax strategist during the year to help you be able to proactively save money on taxes. So what do I mean by that? So as it relates to taxes, there's actually 2 different tax seasons. Okay, you got the tax paying season and you got the tax planning season. Okay, and during tax planning season, that is when you're able to learn and be able to take advantage of all the different tax strategies that are out there. And there's literally thousands of tax strategies out there for you. And if you want to accelerate your results, definitely make sure you go ahead and check out this next video over here, like and subscribe, and I'll see you in the next one. Take care.